Welcome to XYPN Radio, where your host Alan Moore brings you into a community of fee-only financial planners who want to profitably and successfully serve Gen X and Gen Y clients. If you're ready to get the knowledge you need from leaders in your field, learn from forward-thinking advisors, and take action on your own goals, XYPN Radio is the show for you. Here's your host.
Hello and welcome to this episode of XYPN Radio. I am your host, Alan Moore, and I'm excited to have XYPN member Ashley Murphy on the show today. Ash was born in Australia and is now a tri-citizen of the UK, Australia, and the US. After a few different positions, he found a job working for an independent RIA that did a lot of insurance work. While he learned a lot there, he ultimately launched his own firm back in 2013. At the time, he was based in San Francisco, but has since relocated headquarters to Minneapolis, Minnesota. Due to his expertise on insurance policies, he was providing insurance as part of his service model when he first launched. However, we talk about his transition away from transacting insurance policies and why he ultimately made that move. His practice focuses on expats that are dual citizens of Australia and the US, and we talk about how advisors can work with expat clients and the dangers of doing so without being an expert. Finally, we dove into his cash flow process and why he feels cash flow planning is so important and how he uses that to differentiate his practice from other financial planning firms. Missed calls or missed opportunities. Don't miss the chance to connect or bring on a new client. With Ruby, all your calls are answered live by a team of friendly, professional, remote receptionists, helping you win more clients and build trust. Let Ruby help you turn rings into relationships. For a special offer, visit callruby.com/XYPN and use promo code XYPN or call them at 1-844-853-7829. You can find any of the additional resources that we mentioned during the episode at xyplanningnetwork.com/142. Also, be sure to go to xyplanningnetwork.com/VIP to join our private group just for XYPN Radio listeners. It's the community of advisors we've all been looking for that's there to provide support when we need it the most. Best of all, it's free. I encourage you to check it out. Again, that's xyplanningnetwork.com/VIP. Without further ado, here's my interview with Ashley Murphy. Hey, Ashley, welcome to the show, man. Thanks so much for being on.
It's a real privilege. It's an honor to be here, Alan.
Well, I'm excited because this will be the final of the original FP Hackers group. So for listeners' benefit, Ashley, myself, Sophia Berra, Eric Roberge, and then Mary Beth Storjahan, we're all in FP Hackers, which is what we called our study group back in the day. It feels like forever ago because that was started in 2013, I believe.
2013, that's right. Mid-2013. Yep.
So right after Next Gen Gathering. But, you've had a really awesome sort of varied path and sort of finding what works and what doesn't work. So I'm excited, one, to catch up because it's been a while since we've caught up and get a sort of a refresher on the path as well as sort of how things are going. So to kick things off, could you give listeners just sort of an overview of your business as it stands today? Sort of where are you located? How many employees? How many clients? Just sort of an overview, and then we'll dig into the details.
Sure. So, we are located in Minneapolis. I have an office in Berkeley, California as well. Reason being is I was living in California, registered in California, and then had the privilege of re-registering in Minnesota a year later. We have about 40 client households in total, 12 million in AUM. Interestingly, however, about half of my total revenue comes directly from planning fees. We work with two niches and have two brands to work and to be identified by the target markets with. Arete Wealth Strategist, which is focused on domestic business owners, and Arete Wealth Strategist Australia, focused, would you believe, on Australian American expatriates.
And I cannot wait to learn more about that because that is something that I get a lot of questions from advisors that are asking how to serve expat clients. I want to dig into that. So do you have any employees or is it primarily you at this point?
I've been asked that question so many times in the last 2 years, and depending on the month, the answer has differed. So right now, I actually have two employees, but they're both part-timers. I've got Nick Catton, who is a marketing associate who's just working a couple days a week. And I've got Kellen Enright, who, would you believe, started today, literally today, like 3 hours ago. He started Kellen Enright as a paraplanner. So we're excited to have him on board and things are going well.
Awesome. Well, we'll definitely spend a couple minutes talking about how you found him. But to take a step back, you have had sort of a unique path into personal finance here in the States. So can you just sort of give me the synopsis of how you sort of post-college, sort of how you wound your way around into owning a firm, started in Berkeley, now based in Minnesota?
Well, it started even before that, Alan. So I'm not known for my short stories, and I won't disappoint, but I'll try and be brief. So it was actually 1999, moved to the US, took a semester off university, was going to work in the ski fields of Vail, but didn't. Instead stayed in Boulder, where my brother was at the time. And I got bitten by the tech boom entrepreneurship bug. It was going around. It was the height of the tech boom. It was about to crash in a couple months' time. And I started reading Robert Kiyosaki and other entrepreneurship books. And it's funny because the concept of personal finance and entrepreneurship for me for years were conflated. They were one and the same. And I've teased them apart now, but it's funny that they're coming back together, and I guess it's just a reflection of who I am. Someone who's very interested in personal finance, but with an entrepreneurial bent. I imagine you could probably relate to that a little bit too, Alan.
Oh, absolutely.
So anyway, I moved back to Australia, changed what I was studying from psychology to business management and IT. I started an investment club, grew it to a couple hundred people, sitting in on classes I wasn't enrolled in. I was just all about personal finances, and which was hard at a university where they don't teach personal finance, they teach corporate finance. Anyhow, a tragic event happened. My mother passed away in 2002, and I inherited a little over six figures. So for someone that was 20, I was 20 years old at the time, it's like, this is an unbelievable amount of money. It was a little bit over $100,000. It almost felt like I could move to the Bahamas and retire and sail off in the sunset, but I knew it wasn't.
Close, but not quite.
Yeah, right. Exactly. It's funny because at that age, I knew if I handled this well and I had some adult supervision from a professional, that I could really use this as a springboard and as a ladder in my career. And so I went shopping for a financial advisor, and that's when the initial idea for surely there had to be a professional, well-qualified fiduciary sitting on my side of the table that could help me out. And what I found instead, this was in Australia in the early 2000s, was that really wasn't available. I came across a lot of salesmen, and I just wasn't impressed by the landscape. And so I filed that away. I thought, surely there's got to be a way to work with people and their finances in this capacity, but I hadn't seen it, and I couldn't even imagine it. So I moved to the US, traveled around. So I had a startup, actually, would you believe? A startup helping startups. I worked with a VC while I was doing an internship, and it was focused on improving the investment readiness of other startups. And so that was a great experience. We were in a business competition and were finalists in that, and that all went well. And we were approached by KPMG about our product. But I just run out of time for living in Australia. I just wanted to move away to a bigger country with more opportunities. And when a band came to town like U2, I wanted to make sure they stopped in my city. And so putting it all together, lifestyle, big city, MBA, entrepreneurship, that's how I landed in San Francisco. Worked in corporate finance for a couple of years, went to a CFP information session at UC Berkeley Extension in mid-2008, and that really was as much about becoming an RIA as it was about a CFP, because everyone.
What a time to be in there.
Yeah. Yeah.
I can't believe they got anybody to show up. Like, who wants to get into finance at the bottom of the market? Come on in.
It was a shocker, but it's funny, because in a roundabout way, that decision, to be honest, was kind of made for me. I was working at Visa, the credit card company, and a memo went out in late 2008, and they said no contractors are to be renewed. So that was it. It's like, okay, you're marching down the gangplank, and you've got one choice here, my friend. So 2009, we moved to Australia. I was hoping to lure my soon-to-be wife back there, but she did not bite on the line. So that's how it came to be in sunny Minnesota, where it's 20 degrees today. So I was studying for the CFA. I did level 1 of the CFA at the end of 2010. Went through the CFP program, took my time. There was no real hurry, as I couldn't call myself a CFP anyhow. Applied for I'm scrambling a couple of years into a short story here, but From late 2009 to early 2010, I applied for 140 jobs and eventually got hired as a paraplanner at what is still a family insurance general agent's office, where they also do some financial planning as well.
That is a lot of jobs, man. That's like just dedication. What was the challenge in getting a job? Was it just the time period no one was hiring? Was it that people expected experience and you were coming in with credentials but not enough experience yet?
It was all of those things. It was late 2009 was really, maybe someone will know the statistics off by heart, but it seems like around that time was when the unemployment situation was peaking. So that no one was hiring. It was an absolute bloodbath out there. Most everyone you're talking to was like, just go back to school, go to a PhD, ride this thing out for a couple of years because it's going to be nasty. And it was, but it was a blessing in disguise to get the job that I got. It would not have been my first choice, but in retrospect, it's paid big dividends because it has led to me being differentiated in the RIA fee-only space where, like I said, I wouldn't have chosen it to be this way, but it's just what life had in store for me, that I worked at what was a very insurance-heavy company. And so hanging out with my NAPFA fee-only friends, they're like, oh, you know all about insurance because you work in that environment. I was like, okay, if you say so. And I kind of just ran with it. It seemed to be what people thought I knew. And so I ended up becoming an adjunct professor at Berkeley Extension and at Golden Gate under Dave Yeske teaching insurance. So it's funny, it's like they said, you look like you'd play this character well in a movie. And then I started playing the character.
So you own it.
Yeah, exactly.
That's really funny. It started with, the assumption that you knew about a particular thing. And so you just go learn it and continue with it. So this was, you said, more of a family office, it sounds like. So like what was your role at that firm sort of as your, that first job?
It wasn't a family office. It was a family owned insurance general agency. And
I see.
They'd been around for 50 years. There were 16 advisors, very much financial product sales oriented rather than comprehensive financial planning in a broker-dealer environment. And it turned out to be a phenomenal experience. So here I am as whatever I was at the time, 28 or 29, working with 16 advisors, a 16-to-1 paraplanner to staff ratio, which is still the highest I've ever heard of. And I was just cranking out plans left and right. Now, are they as complicated and as detail-oriented plans as what I'm doing now? No, but it was just so interesting to get your bearings around what's normal, what people's situations look like by just doing one plan after another. And it was great from that perspective, as well as doing tons of insurance illustrations and annuity illustrations and going to broker-dealer conferences. And it was great because I had my toe in that world, but people that had known me before the job knew that I was a fiduciary at heart. And so I was the only one as far as I know to this day, I was welcome at NAPFA, at Bay Area NAPFA events because they were like, I wasn't a member because I couldn't be a member, but they saw me as one of their own because that's kind of how I got started and who I am.
Yeah, and we've talked about that, fee only and fiduciary are not, necessarily synonymous, that you can be working in your client's best interest. Obviously, there's conflicts and all the things that we could talk about, but it doesn't make you a bad person to sell insurance. And so many times the NAPFA, sort of the ideology is like, oh my God, you sell insurance, you're evil. And it's like, no, you're not. Like, are there evil people selling insurance? Yes. Are there evil people in the RIA world? Well, yeah,
right,
of course there are.
So. I guess I when I was quote fee based, commission and fees, I gave insurance advice with a heavy heart. I was so worried about being perceived as a salesman that I held back. And what I mean by that is now that I'm fee only, I literally just had a lunch and learn today where we're talking about the tax cut and Jobs Act of last year. And someone was asking about disability insurance. And I said, well, be sure to consider your business overhead as a business owner, business overhead expense. And what about a retirement supplement? And I can recommend that. And I can feel enthusiastic about it, knowing that there's no conflict of interest in me being enthusiastic about it.
Right. No, it's a great point. And that's a transition you've sort of made, right? Is when we first knew each other, you were just like, I mean, you knew the insurance and not only just like handling the transactions, but that's an area of expertise. So how has the transition been from being the one brokering or being the agent on record and actually handling the insurance to sort of the fee only world, which you are now, of actually, advising but not transacting? Like, how has that process been difficult or pretty seamless?
It's actually been pretty easy, and I've appreciated the change because it's represented a narrowing of my roles and responsibilities, and that's been very welcome to be able to do that. So I sold my trails before joining NAPFA, and what I'm finding now is it allows me to be more single-minded in doing that I do for clients. And my story is now much simpler when I'm answering someone saying, what is Arete Wealth Strategy? What do you do? It's like, well, it's really simple. We do financial planning and we do investment management. And for some clients, we do both. That's it. And it feels like my time is less. I feel like I can focus more on those activities because with insurance, the problem with doing insurance, the problem I found was from a workflow perspective. And that was, you make a recommendation. Okay, next appointment, you book and take an application. Next appointment, you need to make sure they do their medical underwriting. Now, invariably, there's some other documentation that's required. So you've got to be going back and forth and back and forth and back and forth. And if you layer that onto your book of business, dealing with all the other dozens of clients you've got, you find all day long, you're just going back and forth, picking up the phone, sending an email. Hey, have they gotten this document in? Have they gotten that thing? To when you're no longer doing that, you're freeing up your time to focus on, just working with financial planning and investment clients and just do that work.
Yeah, it's one of the misconceptions, I think, is that, the hard part of insurance sales is the sales part, when in reality, it's the getting the person the policy part. It's just so much paperwork and all that. And I've always viewed it as like, I'll let one of these fee-only insurance brokers like LLIS or one of these others do it just because I'd rather them do that and spend the time doing that than me spend the time. So it's almost like saving me time, and I'm trading a commission for the time, which has different implications. But it sounds like that's sort of what you're experiencing at this point.
Yeah, and I had to briefly expand upon it. I had a soft transition from fee-based to fee-only, where for a year I had entered into arrangements with a life and a DI guy where we'd split the commission for them to do all of the underwriting. And that only worked so-so. I wouldn't say I was thrilled with how one party performed, but not with how the other party performed. And then it becomes a reflection on you when you're still intricately involved and you still have that, you are financially compensated for the business. And so your reputation is on the line for how they're handling themselves. And it was maybe more of a headache than what it was worth. In terms of my total revenue, it was only worth about 15 to 18% anyway. So It's been interesting, the financial transition going from fee-based to fee-only, because I lost, obviously, that revenue source, although I also got a one-time bump from selling the trail. So that was nice. But I had a couple informational interviews with fee-only advisors about making this transition, and unanimously they said, the additional revenue you'll get by being fee-only, by NAPFA's Find an Advisor tool, will make up for the lost revenue. And I've got to be honest, I've been disappointed, because since joining NAPFA, I've noticed this thread that's been going around about why the Find an Advisor tool isn't working anymore.
You came in just at the right moment.
But it's actually still working out okay, because I didn't get an opportunity to mention this previously, Alan, but I'm doing the Limitless Advisor coaching course with Stephanie Bogan and Matthew Jarvis. And that is really helping focus my mind on, there's $10 an hour work, $100 an hour work, and $1,000 an hour work. And for me to be reviewing my prospects and to be actually implementing my marketing plan, which I otherwise have had no time to do in the past, seems to be really bearing fruit and being a productive activity.
There are a lot of advisors out there that are, that have trails, have been handling insurance. And this is a very common question of what do I do with the trails? And I don't have a great answer. So can you tell me what the process was like finding someone to take over those trails or buy those trails and sort of what that transaction looks like?
Yeah, absolutely. So I've been thrilled with how it went with the disability insurance agent that I used, and I'd be happy if anyone offline, if they want to follow up with me on that, I'd be happy to make an introduction. He had a template from a previous transaction with someone going fee only, doing exactly what I was doing. And essentially, we had a good professional relationship for a couple of years. I explained to him, I modeled out all the trails when I signed the business, how far they were through, because it's a 9 or 10 year payoff with disability and the way that commission stream works. And I just made him an offer. I said, here's whatever the total sum of future premiums was. I took, it's like a third of that total amount to make it more of an incentive for him, because I don't know what the likelihood is of these clients persisting to pay their policies. So I just made him an offer and said, hey, well, will you pay me a third of the total value, the total future value that we expect to collect if every one of them renews and continues to pay their policy? And he said, absolutely. And of course, it was at that point, I was like, shoot, I probably underbid that, but it was still, a couple $1,000, and that was helpful at the time. As for the life policies, there really wasn't much to do, to be honest, because I had only ever written one permanent policy. There's probably a presentation to be had at a conference at some point in time, because I defend that policy and say it made sense in light of absolutely all the opportunities available for that client. So 99% of what I ever wrote was term. And term pays its commission, it's kind of one and done. So there isn't a trail to sell. There was, however, a bunch of business that was pending at the time I went fee only. And so I approached that agent. You heard me earlier mention that I was working with someone who was doing the underwriting. So I already had that relationship. And I said, listen, what about this? If you pay me 3/4, note the difference, but in the future values over 10 years versus 3 months, I wanted to incentivize them and say, hey, you're essentially forwarding me this money. I will refund it to you if they fail underwriting and nothing, if the case doesn't proceed. But otherwise, you've basically just picked up a couple $100 for continuing to do your job and paying me out early for this so that I can say I'm done with insurance trails.
Yeah, it's such a crazy process because it's not like you can just, again, you can't just email the insurance company and say, hey, keep your money, which you would think.
I'm sure you could. I'm sure there's someone in that screen that would be happy to pick up that email and be like, oh, you got a heavy heart, guilty conscience about that? Let me take that problem off your hands.
And previously, NAPFA actually, before the CFP board created their new definition of fee only, in NAPFA, you could actually be a member with those trails. You had to contractually obligate yourself to donate those trails to a charity each year, which I think was wonderful. I think that's a fabulous sort of middle ground. Instead of having to just get rid of them, you can still get them and just donate them and, send it to the Foundation for Financial Planning or another cause that you're focused on. But alas, the CFP board did not keep that as an option, probably because they don't know how to monitor it, which I get. Monitoring 75,000 people saying they're doing something is fun.
Yeah. It was pretty strict. In fact, I was the one, and Maddie can vouch for this, I was the one that ended up having to, I wrote to NAPFA and I said, what's the policy here? And it is very, very, very strict. It is no trails, no nothing with your ongoing.
Yeah, it is now for sure. Yeah, what happened was CFP board created their new definition of fee only, which was different than NAPFA's definition, which technically, and we run into this where someone says oh yeah, but I'm in this special circumstance. I'm like, I get it. You're married to a real estate agent. Technically, as of today, you're not fee only. Now CFP board's reviewing that rule, but and I'm like, well, yeah, I would love to hold you out as fee only, but if I do, and if NAPFA holds people out as fee only that CFP board says are not fee only, suddenly, you start getting either losing the CFP marks or getting a letter posted on Google that says, you're a crook, basically, which no one wants. So anyway, it's a very interesting process, but we have a lot of advisors out there that could be going through this or want to go through this. There are some that say, look, I got $100,000 a year in trails and I don't have a good, okay, good for you. Just continue doing what you're doing. Right. If it's a massive amount of money, if it's a few $1,000s, it may not be worth it. And again, there's some marketing leverage around being fee only. And again, just not having to service or write new policies. So taking a step back, we sort of jumped ahead. You were working at that family-owned insurance company. And then was that when you made the decision to start your own RIA?
It was and it wasn't. So it was, beginning of 2012, I was planning to sit the CFP exam in April, and I was kind of preparing my runway for 2012 to become an advisor by September of that year, which I did. September 1st, 2012, I was the first day I was a financial advisor. And given that I'd been working at this company for 2.5 years, I felt I would have a whole pass to kind of do what I wanted. Like I was, that good paraplanner that everyone knew. And I thought that would let me get by doing the kind of, monthly retainer kind of financial planning that I wanted to do. But it turns out I didn't have a whole pass. And they're like, you're not selling the number of annuities and whole life insurance policies that we expect of you. And so it was at that point, the writing was on the wall and I knew I had to walk. And this was, heavens forbid, before XY Planning Network existed. And Alan, that would be my default answer to the final question that I know that you ask on these podcasts. It would be join XY sooner, but it didn't exist at that time, unfortunately, in early 2013. If there was a time machine and somehow I could teleport myself for, a year, it gets complicated and messy there. But so about, early 2013 was when I began the registration process. And so I felt like I almost had a year of, quote, being on the beach as I kind of kept the cases I had alive from this old company. And I wasn't able to prospect and take on new clients because I was between the two. It was in August of 2013 that the registration finally came through. This is in California, so it literally took them 4 months. People complain in other parts of the country, but you ain't got nothing to complain about being in California.
Do you remember, was there something about your firm that they were unsure of and they had to look further into, or was it just that was it, from beginning to end, that's what it took?
That's what it took. I don't recall there being any complications to it at all.
Yeah. And every state's different. You came in at a bad time, quite honestly, when it came to RIAs, because I'm trying to remember what year. It was Dodd-Frank, right, that moved us from the states to register. Right. It used to own everybody that was under 25 million AUM, and then they gave the states everyone under 100 million. So then all the RIAs that used to be SEC registered got kicked back to the states, and so quite honestly, the state regulators just got buried. And there was a time where, that was normal. We still have a few states that are challenging. I will not name them because I don't want any calls from the members in those states for making any regulators upset. But there are some that are just slower at processing, and there are others that are just freaking on it. And they can get it done in a week. Others take several months. So it's part of what we warn advisors, that it just takes time sometime, and it's not something you can actually control.
It was a tale of two cities moving to Minnesota. The registration process here, which I had to do all over again, was so smooth. In fact, I think it was like 2 or 3 weeks. It was unbelievable. And then a policy here where they audit you in the first 6 months just to see that you're on the up and up. And so not only was I registered, but then 6 months later audited. I felt like we had a good regulator here that's on the ball.
Tell me about getting audited. What, again, this is one of those things that a lot of advisors have never been audited before. They're starting an RIA, and there's this terrifying, thing that happens when the regulators come in and they try to put you in jail. So, and for listeners, I'm being facetious. But tell me about just what the audit process looked like there in Minnesota.
Yeah, I think it's different from a more comprehensive audit. This is a new advisor audit. So I think they basically want to see that you've been able to set up client files and that you're billing the way that you said you would as per your ADV. It really wasn't that bad. They gave me a month's notice. 2 regulators came over to my house, looked through a bunch of sample files. They did not look through every single client. They looked through 3. They wanted to see that the client service agreement was in place, that things were being charged as per the fee schedule. They did not want to, see email or web archives or any of this kind of stuff. It was a fairly light audit.
Okay. Yeah. And I'll be interested to see your next audit, if it's the same, because I had the same thing when I was in Wisconsin. They sort of came in, sat down for half a day, answered questions, be sure I was set up correctly, anything that was wrong. Like I wasn't getting deficiency letters. They just said like, hey, move this here, move this there. Be sure you're tracking this. Be sure you have a file that says for any clients that have fired you. And I was like, I don't have any clients that have fired me. And they're like, well, you still have to have a file for where you would put someone that fired you, so kind of painful, but they're not there to shut you down or put you in jail. And I think that's what's so important for folks, especially that have been on the broker dealer side of the house or the insurance side of the house, is just to recognize that like RAA compliance is not nearly as scary as people have made it out to be. And they're just there to protect consumers. And if you are not stealing your client's money, you're fine.
Yes.
You'll be okay.
Yep.
So
it was a collaborative approach. It was they as you said it. They were there to be like, how can we help you be compliant? And approached it thinking that I'm doing the right thing from the get-go. So it was a model experience for how to interact with the regulator.
So when you were getting registered and sort of launching your own RIA, were you able to bring clients over with you that you had at the insurance company, or did you have to start sort of fresh from the ground up?
I should say more accurately, was given a client that didn't fit with one of the existing advisors. And so he was someone I brought with me. I had to repaper everything, move to a new custodian, new client service agreements, all that sort of stuff, which we did. And then let me think about that. I don't think I had to do new client service agreements. Actually, that's not true. No, I did. I did have to do new client service agreements when moving from California to Minnesota. But the exit from the insurance company wasn't as complicated as it has been for some other members that you've had on this podcast, simply because I was a paraplanner for almost the entire time that I was affiliated with them. And then bar a couple months where the business I brought in was my own, plus one other client that an advisor gave to me. And we had a very cordial relationship with one another. And still would. He lives in a different part of the country to what I do now, but it was all very clear, on the up and up. Yeah, it was uncomplicated.
All right. Well, that's good to hear.
I hadn't, as I mentioned, but I hadn't sold any annuities or permanent life insurance policies, so there really wasn't any repapering from that perspective to be done.
So you obviously born and raised in Australia, came to the US, and it's sort of a natural fit, if you will, because having lived there, Australian laws a lot better than most of us could. Obviously, you trained in the US and got your CFP and CFA here. So did you find that was just sort of a natural, you mentioned that sort of your niche or one of the brands that you're working with, that was just sort of, what you knew, or was that an area that you really, went after and have just had to learn a ton in order to be able to work with clients that are sort of in that niche market?
There was a lot of sales training that I did at the insurance company. And that is something that I'm very glad that I did is, the sales training. And that was an experience I was happy with from that insurance company. And they would constantly come back to, sell to your natural market. The riches are in the niches, and go with who you know and all that sort of thing. And I thought, well, man, I don't have a college, alum crowd that I can connect into. I do have workmates from previous jobs and stuff, but I just didn't have much of a natural market, if you will. And just a correction, I was actually born in the UK. My dad was visiting economics professor at that time. So I was born in the UK, raised in Australia, and my mother was American. So I've been a tri-citizen of Australia, UK, US.
That's amazing.
From birth. Yes. Very, very clever when I was first out of the womb, and it's just been a gradual decline ever since then.
So how common is that to have tri-citizens of those three countries? Like, is that a potential niche, or is that just like by accident, like a few people?
It was by accident because a couple months after I was born, the UK changed their laws. It used to be in the UK, I guess, prior to 1982, used to be that if you were born there, much like in the US, you're instantly a citizen. And then from 1982, I don't know exactly when it was because I was only a few months old, but from sometime early 1982, they changed those laws. So I got in just under the wire. And people ask me that all the time. They're like, oh, so if you're an Australian, are you automatically British? No, that's not the case. It's a pretty rare thing. And it's taken a while to get my head around it and, kind of figure out who I am in this world and, how do I differ from other advisors and so forth. But the answer is no, it's less of a niche than what you might think because it's so complicated, it's so involved, it's so taxing just to be a good advisor in one country. And I'm trying to do that in two with the Australian side of things. And to think about adding the British to that, it's a little overwhelming at this point, to be honest. That's the short answer.
That's really interesting to hear because, again, I have advisors. I see it all the time. Like, hey, I just got a client that's, live in the U.S. and is also a citizen of Canada or Mexico or the UK. And they're saying, any potential pitfalls. And I'm assuming for someone with the expertise that you have, any potential pitfalls would be a very, very long list of don't make any recommendations because you're going to screw something up.
Well, it's funny you should mention that. So I've been a part of the International Knowledge Circle with the FPA since 2010. And there's an advisor, a Canadian US advisor, Brian Ruck is his name. Great guy, has written a couple books. He spoke at the FPA conference in Nashville. At first, I thought he was a real curmudgeon because whenever a question would come up to do with Canada relations and cross-border clients, he'd basically say, listen, being a CFP means being an expert and being a professional and sticking to your knitting and knowing what you're doing. And if this is not your niche, if you do not know all the regulations and all the things that could possibly affect a client, then it would be like me advising a divorcing client or a client with special needs on a special needs trust or, any of the other niche, student loans or pre-college asset shifting to minimize expected family contribution. Like these are super detailed and specific areas of financial planning. And so I guess I've come around to see where Brian's coming from. And that is, I see it all the time where people say, oh, I've got a client who's British or Australian or whatever. And I just think to myself, oh, so you must know then that you can't advise on any of their Australian assets because you'd need an Australian financial service license, or you'd know that what the accredited advisor exemption amount would be, or you'd know that they get tax-deductible life insurance through their superannuation, or you'd know that you can't invest in an ETF or a mutual fund because that would be considered a passive foreign investment corporation that would be subject to punitive tax treatment. You know all that, right? Oh, you don't? Oh, that's a shame. Why are you dealing with a client that you have no expertise in dealing with? And I just hate to say it, but that's kind of the angle that I've taken. The more I've gotten to know about it, I don't currently have E&O insurance that covers me for Australian advice, but at least I know that I have that risk. I'm looking into getting that quoted. I work with a brokerage custodian that will hold assets in multiple currencies and allow for foreign currency conversion. My practice is set up to serve those clients deeper and more comprehensively than what you could if you're just dabbling in the field. And so that's the opinion that I've come to.
Yeah, I mean, I say this all the time to advisors when I'm speaking, and that is, people always want to know, like, do I have to have a niche? And my thing is, eventually, niches kill the generalist, because when a client comes to me and they say, yeah, I'm Australian expat, I'm in the US, I have assets in both countries, and I have my pension in Australia, but I have some real estate in the US. And quite honestly, if I take that client, I'm going to half-ass it and I'm going to do a bad job. I'm just not going to do a good job because I don't know anything about, I've never worked with a client from Australia. But if you and I are quote unquote selling to the same client, and you go through what you just went through on here are all the things you need to be thinking about, and I'm saying like, oh yeah, you should be fine. I work with lots of clients. You're going to get that client. And if you don't, I should be referring that client to you. So I'm curious though, because like knowing all the laws in the US is hard enough. Obviously, you can't even know all the laws, and having a niche is hard enough in the US. But to your point, to truly work with clients, that have dual citizenship or at least real estate in multiple countries, like you kind of need to be registered in both countries. Or do you see the future advisor being able to just singularly work with that client? Or do you think you're going to have to ultimately team up with someone in Australia and the two of you, I mean, that client's going to need to have two advisors working together?
That's right. And I think this is a very broken part of global financial planning right here, Alan. I partner with a number of planners in Australia because I'm not interested in getting registered there. And I'm not interested in getting registered there because the compliance landscape there is 10 times worse. I know that's actually probably not an exaggeration, 10 times worse. The delivering a financial plan is almost templated. The whole thing is prescribed. Like basically you have the liberty to fill in a couple boxes because you must disclose this, and this, which would otherwise be superfluous or you could provide to a client here if it was necessary, whereas there it's prescribed. So, and the annual audits and the costs, it's not even on the horizon for me. So I work with a number of partners there, but then it gets a little tricky because it kind of comes to be about the professional understandings that you have. And here's a perfect example of where things get tricky. So Sunday evening, I received a prospect emailed me out of the blue, said that he'd watched a joint webinar that I did with one of these Australian advisors a year ago, CEO of some Australian company that somehow has moved to the US. And he said, so who of you should I talk to? And that gets tricky because, everyone wants to be the lead advisor, especially if it makes more sense. And we haven't yet met with this client, but the academic answer I would give to it would be, of course, it's at the client's discretion, but it would make most sense for the lead advisor to be the advisor in the country where they see themselves as having their long-term primary domicile. Where do they see themselves in the long run? Because how much sense would it make if he sees himself being in the US the rest of his life, having an Australian financial advisor who's not licensed in the US, who cannot give investment advice, who cannot recommend a custodian? Well, he might be able to recommend a custodian, but it would only be on a retail basis. He just can't do anything that I, as an RIA with institutional relationships, can do, and likewise on the Australian side.
Yeah, it's really interesting. I mean, you almost have to have agreements and sort of spell that out on the front end to say, look, like I'm in the US, you're in Australia, we're going to work together, with clients that come in that are, that need both of us. However, wherever that client is, sort of their country of residence will be lead and the other one will take sort of second chair and figure out, what revenue looks like because of that and how you're going to charge the client. But I can see that because there's both the compliance and the regulation side, and then there's just do you have the knowledge base to truly advise in both, even if you could be registered in both easily. And it's just a lot to know.
Exactly. There is so much to know, but not quite as much. How do I say this? There's actually two additional bodies of knowledge to have. One of which is the knowledge of the foreign country, but you don't need it as deep as what a local CFP would need, and I'll get to that in a moment. But then there's a second body of knowledge that does not exist. It does not exist in any formalized manner, and that is the interaction of the two. So there's the US laws and financial landscape. There's the Australian laws and financial landscape. Then there's this third body of knowledge that comes in the interaction of the two. How is a 401k taxed if you move back to Australia? How is it taxed? And this is actually different if it's rolled out to an IRA. The tax changes. How do the Australians treat a Roth? They don't have anything like a Roth. How do they treat a Roth? Well, you might know what a Roth is in the US. You might think or I don't, by the way. I don't think I know what a Roth is in Australia. I don't know how it would convert, but that's a whole nother set of knowledge, is knowing the interaction of your host country and the foreign country.
So you mentioned that you have two sort of niche markets that you focus on, that being one. Remind me, what is the other niche that you have?
The other one's domestic business owners. So when I get talking to these Aussie expats, I say, look, listen, first and foremost, I am a US registered investment advisor, and I've been dealing, with US clients for 8 years, and, I've seen hundreds of cases and so on and so forth. So first and foremostly, I'm a domestic advisor. And it was the domestic business that I used to get the international business going, because as you've had many discussions with folks and have appreciated the studies that you've done as well, it's been slower to get the niche going, but it's also stickier and with higher conversion rates on the Australian side because of the familiarity and the knowledge that I have in that area. So wealth strategists focused on business owners got Wealth Strategists Australia going.
Got it. And so talk to me about that niche and sort of the clients that you're working with, is it just sort of any business owner, or is there a focus within that?
No, it's more to do with the mindset of a business owner. I really identify with these people that see the power and the opportunities that come both from a financial, but also is something different about the mindset and the personality of a business owner that I just really identify with. On the Australian side of my family, I come from going back to my great grandparents, they were all self-employed entrepreneurs of one variety or another. And I just really identify with that energy. And what struck out at me going back to that 1999-2000 period when I'm reading Robert Kiyosaki and all these sort of very entry-level kind of personal finance and entrepreneurship books was the thing with starting your own business is, aside from being an employee, as an employee, you get paid for your labor. As a business owner, you are actually building an asset. Not only are you hopefully making a profit and getting paid, an income as you go through, but at the end of it, we've got something to sell. And so there's a whole nother mindset that comes with cultivating that asset and getting ready for an exit. And coming to the country as a foreigner, I guess I look at it maybe with fresh eyes, and it seems to me the surest road to riches and financial independence in this country is to be a business owner. There are just so many tax breaks. There are so many opportunities for dual use assets, to implement employee benefits, to take additional, retirement plan or make additional retirement contributions that you're simply not able to as an employee, and you are able to as a business owner.
Well, it's a great point that it is a beautiful thing to be able to, get an income for yourself, create flexibility, but also have something that like you said, it has enterprise value. It is something that's worth something if you were to pass away, that your wife and kids would actually get something. However, we need employees, right? It's not that everyone out there needs to be an entrepreneur. However, for those of us, I would say, that are sort of wired that way, it really is a fun experience. It's stressful, but it's fun.
Exactly. And I completely agree with you. We need employees, and some of us need to be employees. And I'd put myself in that bracket. I needed to get the schooling and the experience before jumping out as an advisor on my own.
So one of the things that I remember from being in the study group with you and sort of conversations that we've had over time is that you have experimented quite a bit with service model, particularly around the investment management side. And I remember a lot of this was driven by your expertise in that, being a CFA, that, you had the credentials and the background expertise for that. But talk to me, a little bit about sort of some of the evolution of your service model, both planning and investment management, and sort of where you've landed today that you're finding success.
Yeah. Well, thank you for that question, Alan. I love it. I do want to say I'm not a CFA charter holder. I've got a lot of respect for the people that have done that. I did level 1, and maybe one day I will complete level 2 and 3. Yeah, that's absolutely right. I was on the investment committee, and I was comfortable doing security selection for myself. So I'll be honest, when I started in late 2012, 2013, if you could fog a mirror, you were a good prospective client for me. It was a race. It's a race.
Understood.
It's a race against insolvency, and I was sure gonna beat that vicious competitor that I had, that insolvency being that competitor. But as time has worn on, I've really gotten more disciplined about accepting clients that are closer and closer to fitting my niche. And those that aren't, I'm getting, and maybe in conjunction with that coaching program I alluded to previously, I'm getting more confidence and more of a backbone and being like, you know what? If I say no to you, it frees up more of my capacity to find the clients that I do want to work with. So to start off with investment management, I was doing it in-house. I went with one of the startup custodians, and that was a big mistake. And I didn't realize it at first. I wasn't able to go with a TD or a Schwab or a Fidelity simply because I was starting from nothing. So I had to go with one of the startup custodians. And the problem that created was, are people going to entrust their life savings to some no-name custodian that they've never heard of before? And the answer was, by and large, no. It's going to be more difficult with sophisticated clients with real assets under management. So I've kind of always had a dual custodian approach. One of them is Interactive Brokers I've had since the beginning, and the other has swapped from this startup custodian to TD Ameritrade, where I was accepted prior to joining XY Planning Network just on my individual business plan and assets under management. And so Interactive Brokers is really to cater to the international crowd. Interactive Brokers has got many great things about it, but many terrible things about it. And so it kind of averages out in the middle there. They've got some unique capabilities with trading and foreign exchange and margin lending, but they're just simply not set up to work with advisors. And I could tell you more stories about that, but they make doing business extremely difficult. But they also have a monopoly when it comes to this expat market. And so the transition that's happened over time is I've moved from doing my models in-house to working with a TAMP. I was working with 2 TAMPs and looking to consolidate that all with XYIS. Yay!
Woohoo! I didn't know that.
There you go.
So XYIS being the XY Investment Solutions is the TAMP that XY Planning Network has for our members that want to outsource some of this work and focus on running their business. But I did not realize you had signed up with XYIS.
I'm getting there. I don't think there's that wet signature or e-signature quite there, but I had a detailed due diligence call just last Friday with Brandon. So
awesome. Well, he'll be hounding you now. You said it publicly. Right. 3,000 people are going to hear you say you don't have a choice now.
I've made my bed. Now I just need to lie in it.
I don't know a lot about Interactive Brokers, I guess. So, I mean, is this sort of like Interactive Brokers is for the assets that your Australian clients are holding for currency reasons, everything else is at TD, or how do you decide when an account comes in, where to put it?
So, great question. Mostly it's for the international clients, but it's not the full answer. It's also for my more sophisticated clients where I run a separately managed account strategy as well. And so their trading capabilities kind of offset the user interface and user difficulties you have in dealing with Interactive Brokers. So their trading fees are incredibly low. They start at $1 per trade and go down from there. You can set up, model portfolios and trade, to all sorts of stock exchanges all over the world. And it costs very little. And their margin lending, not that I've used that very much at all, but their margin lending is unbelievable. It's the cheapest money to borrow, bar none. And I mean bar none. It's unbelievable. But as I mentioned, it's only for the right kind of client, and it's very, very rarely been executed upon.
Okay. So based on that, I assume the majority of the assets sort of floated now TD Ameritrade, and then you have some with Interactive Broker. Is that sort of how it's going to get split out?
It's split between, there's 1.5. I do 401k plans as well. I'd like to delve more into that. That's part of the business owner offering with the domestic clients. So it's 1.5 there. There's, 5.5 with TD. There's 2 with 2.2 with Fidelity using the brokerage link service, and I guess the remainder is with Interactive Brokers. So it's kind of all over the place, and maybe you can figure this out just from everything that we've said and all you know about me. But that's my problem is I can get a little bit scatterbrained and then eventually have to draw myself in and be like, listen, this is just inefficient having this money all over the place. But I did recently, and you may have saw it in your most recent quarter town hall, I was asking about Morningstar as a service offering for XYPN. And I went and got it anyway because it just makes sense for how my business is operating. With it gives me detailed mutual fund analysis, stock analysis on the Australian side, the US side. With buy all accounts, I can report on all of that at a household level, regardless of the custodian. And Total Rebalance Expert is now also part of the package. So it's
very cool.
It's like they've given me my own personal atomic bomb, and I'm just my mind, my mind has been blown as to like, what on earth am I going to do with all this power? So I'm expecting a year to even get my head around it all. I understand it. I've been sold on its capabilities. I understand what it can do, but we haven't, really unwrapped this thing yet to even see what's under it.
It's not a service offering that we currently have, but we may need to roll out like a technology addiction program at XY that we sort of like, we get the authority to block technology purchases to keep you from owning an atomic bomb. Because it's true, there's so much capability that it can do. And as you grow and you have 100 million and then $1 billion under management and you have a team of people running it, it's great. But being a, solo now with 2 part-time folks, trying to run your business and going out and getting clients and then to come home and to try to, do a detailed Morningstar analysis on a portfolio is tough. It's just tough to context switch that much. So, many times we do see that, the power of those technologies is great and you want to harness that. However, it's not always 100% necessary. But again, it's your area of passion, so it makes sense.
Mm-hmm, mm-hmm. Yeah. And what makes it worse actually is they're transitioning from their PC desktop to a cloud version, and the cloud probably has 1/4 of the functionality of the desktop. The desktop is on a PC, I'm on a Mac, so it's just been a nightmare trying to learn 2 completely different programs on 2 different platforms. It's been a distraction, but I'm optimistic as to the possibilities that it will open up.
So you mentioned earlier that you have hired a paraplanner. So can you talk to me about the decision to hire someone and sort of the process you went through to find that individual?
Yeah, absolutely. So he's actually the 3rd paraplanner that I've had. The first one of which, Matt Gorin, and hey, Matt, if you're listening, he was great. He was one of my top students from when I was teaching at UC Berkeley. We started working together, but then due to it, a business wasn't at a point where I could bring him on full time. And then there was a change in his lifestyle and it essentially didn't work out. So he's now a professor in personal finance at your alma mater, actually, Alan.
Oh, really?
Yep. In Athens there, teaching an entry-level financial planning subject. So there was Matt, and then there was someone in the middle there. And then most recently, I hired Kellen, who began earlier today. And I found him, and this is just why I'm so thrilled with the resources that you've brought into the world with XY Planning Network, and to see it from the ground up, from pre-inception to now, it just blows my mind, and it's a real inspiration to me and many others out there, I'm sure. But a corollary of this effort was, I guess, indirectly, was Simply Paraplanner, that I understand Sophia's paraplanner Alex got going. And talk about providing an unmet need, like this is a fantastic service. And I had many applicants and very happy with who I've chosen. Turns out he's not virtual, he's in person. And I'm optimistic to see him grow to become a full-time employee.
Yeah, that's awesome to hear that you were able to leverage Simply Paraplanner. Folks can go back and listen to xyplanningnetwork.com/123. And Alex, who is the founder of Simply Paraplanner, is Sophia Berra's paraplanner, I assume still is, or she was when she was on the show, and that episode is all about sort of building out this platform to hire paraplanners. Primarily, the intention is on a virtual basis. However, sometimes you get lucky and they live down the street. And then you realize that you have to get him office space, which is expensive. Yeah, right. So it's not always the best thing. However, that's fantastic to hear that you've been able to find someone on a part-time basis. Do you mind if I ask, is he also going to be working for someone else during this, or is he only going to be working for you with the expectation that he needs to ramp up within a certain time period, or he's going to need to go find a full-time job?
Yeah, no, that's a great question. And that, I think, is why I'm appreciative that he's taken me on. And of course, he's appreciative to have the opportunity as well. But I am looking out for him, and we're talking about what other work he might be able to do to supplement his income. The thing that comes to mind first of all is, particularly this time of year, is doing seasonal tax work. Kellen had begun as an accounting major, and so at least has some capability and some knowledge in that area. And I know my brother had gone down that road. He actually ended up getting a master's in tax, and that's what what he does as well. And so I thought, well, at least there's that for the next couple of months. That gives me a runway to try and expand the business and increase the number of hours between now and then. But there are other opportunities that he's looking at as well.
Okay, fantastic. So as we're sort of coming to a close, as listeners can tell, I know more of your story than sometimes when I bring guests on. There's so much that we could talk about. I guess I'll ask. I don't normally ask this, but because I've sort of driven the conversation just based on some of the knowledge you background. Like, were there any areas that you were hoping to touch on that I didn't touch on, or any questions I should have asked that you want to be sure we cover before we close out?
Well, thank you yet again. I'd say just only one thing, but I did touch on a little bit, and that was the evolution of a funnel, and of course I'm thinking of my funnel there, but that is what I mean by narrowing the funnel. Is raising your minimum doesn't just have to be literally raising your minimum. It can take on a lot of different things. It can mean no longer doing nights and weekends. You're raising your minimum. It could mean, as I'm doing this year, not doing home visits with clients. I'm not doing that. It's time.
And that was something you did in the past?
It was something I did in the past. And I'm just not doing that anymore. And that's another raising of the minimum. So raising your minimum can mean narrowing the clientele that you're working with to be more precisely fitting with your niche. It can be narrowing your services, like if you were previously doing insurance and no longer doing that. It can be decreasing your hours of availability for clients from nights and weekends, which, it's not every other young family wants to be doing nights and weekends. That's the only other point that I was going to mention. Actually, and one other, and that was to do with cash flow, but we'll probably have to find another time for that. And that is the passion I have for getting deep into cash flow with clients.
No, let's take a minute, because I think that's a great point that, when we're working with younger clients and business owners in particular, that cash flow is not always a topic that advisors are comfortable in, because quite honestly, the CFP doesn't teach you how to do a cash flow, like a true deep dive cash flow analysis, because most advisors are used to working with clients that already know how to manage their cash flow. Right. We're used to working with clients that are already wealthy, and they didn't get wealthy by mismanaging their money. So talk to me about sort of your process and what differentiates you from maybe some other folks that are out there.
Yeah, this has been a bee in my bonnet for years. And it was actually a topic of discussion in our old study group. It was, how do we handle cash flow? And I remember thinking, oh man, it's so inefficient that I'm doing this, but I just can't give it up, like any addiction, right? I just can't give it up. And so I've instituted a whole what I call the cash flow waterfall. It's a philosophy of how I recommend my clients manage their budget, because if you can't measure it, you can't manage it. And there's so much low-hanging fruit out there in terms of being able to optimize, automate, and maximize the benefits you get from running your cash flow in an efficient manner. And I'd be willing to offer to XY Planning Member Network members my spreadsheet. I have part of my client intake process includes the client completing a Google Sheets spreadsheet that we've created that lumps their cash flows into monthly, non-monthly, discretionary, and other savings categories, and then plays nicely with eMoney. And if anyone out there is an eMoney user, they'll know what I mean by that, because eMoney's definition of living expenses actually includes a whole bunch of other things that are very commonly double counted, like insurance premiums for one, liability, like mortgage payments for another. If you don't specifically back those out of the living expense number, then you're double counting someone's actual living expenses and overstating their need and telling them they need to work another couple more years when in fact maybe they don't.
It's a great point. Yeah, like I said, it's an area where we can certainly dive deeper, and there's not a lot of training out there. I know the AFC, the Accredited Financial Counselor designation, goes a little deeper on that topic, and there's always more to learn and more to do, but
of course. Yep. I know that.
So Ashley, I know you sort of threw out one answer to the question, but I'll ask you again and make you come up with a second answer. Just sort of as we're coming to a close. So if there's one piece of advice that you would go back and tell your younger self, that one thing you wish you had known then that you've learned over the several years of owning a business, what do you think that one piece of advice would be?
It would be take the consultants, take the coach's advice, stick to your knitting, follow a plan. Don't try and be everything to everyone, and really appreciate that time is not a renewable resource. You need to be very focused and very disciplined with your time. That's what I tell myself, is don't spread yourself too thin, and just focus on where you think you're going to have the greatest success.
I love it. It's awesome advice. Well, thank you so much for taking the time to come on the show and share your wisdom and what you've learned over the years. So I'm super excited to have learned, gotten caught up and excited to see the next, year and several years for you. So thanks so much.
Absolutely. Well, it's my privilege, Alan. And I know the community is so grateful for what you've done. It's amazing.
Missed calls or missed opportunities. Don't miss the chance to connect or bring on a new client. With Ruby, all your calls are answered live by a team of friendly, professional remote receptionists, helping you win more clients and build trust. Let Ruby help you turn rings into relationships. For a special offer, visit callruby.com/XYPN and use promo code XYPN, or call them at 1-844-853-7829. Be sure to join our VIP community at xyplanningnetwork.com/VIP to hang out with other XYPN radio listeners, ask questions for future mailbag episodes with myself and Kitsis, and to finally find a community of like-minded financial advisors. Thanks so much for joining me today. We'll see you next time.
You're not alone, and you're not crazy. It's scary starting, building, and growing your own financial planning firm. And that's why we put together a free private community just for you, the Cutting Edge Financial Planner. Go to xyplanningnetwork.com/VIP or text XYPN Radio to 33344 and join a network of thousands ready to change the lives of Gen X and Gen Y clients.